Welcome to Financial Insights in Minutes. Today, we're dissecting crucial economic signals, analyzing routes through critical economic updates and market fluctuations. Is the economy on the brink of disaster?
We'll cover insights on consumer spending, credit card debt, and the implications these have on potential recession risks. Stay tuned as we reveal expert opinions on trading strategies and market pressures.
Let's dive into today's featured videos for a deep dive into these critical discussions. Stephanie Pomboy reveals hidden dangers in retail sales and advocates for investing in cash and gold. Jack Schwager discusses market volatility and successful trading strategies amidst uncertainty. The Trade Brigade assesses if the market can continue its upward trend amid current pressures. Eurodollar University uncovers the implications of crashing steel prices on the global economy. The Technical Traders explore how investments in gold and bonds are shifting amidst stock market struggles. Figuring Out Money warns that the S&P 500 may soon cool off after reaching new highs. Ted Oakley outlines the dangers of overvaluation in the stock market and rising economic distress. Bob Elliott explains how post-GFC regulations have altered the debt landscape in the U.S. Welcome, everyone, to Kitco News. Today, we're diving into the captivating insights on the current economy. Retail sales are surging, but is it a deceptive glimmer of hope? Joining us is the astute Stephanie Pomboy from Macro Mavens, here to enlighten us on the hidden dangers of the consumer market.
Thanks for having me. Let's get straight to the facts. Today's numbers might look good on the surface, but there's more to dissect.
What's Stephanie's main thesis in this economic analysis?
The crux of Stephanie's argument is that while retail sales seem strong, deeper analysis reveals significant underlying weaknesses. This facade might mask serious economic challenges, prompting a call for careful investment, particularly in cash and gold.
Let's break down the key points, starting with retail sales. What's the scoop on those numbers?
While retail sales jumped 1% last month, strip away the autos and gas, and we see a mere 0.4%. Plus, revisions often lower these figures later.
What about consumers and their debt levels?
Consumers are becoming increasingly reliant on credit, and delinquency rates are on the rise. It's a clear sign that many are struggling to manage their finances.
Let's discuss the labor market. What's the latest there?
Jobless claims fell, but the quality of jobs is questionable. Many are working fewer hours or juggling multiple jobs just to make ends meet. Definitely not ideal.
What kind of predictions did Stephanie make?
She foresees potential spikes in credit card defaults as consumers struggle to manage their debts. A clear warning: we are on the brink of significant economic challenges.
And how about investment strategies moving forward?
Stephanie strongly advocates for cash and gold as defensive positions, anticipating that market instability will deter risky investments.
Wrapping it all up, what are the takeaways from Stephanie's insights?
The major takeaway is to navigate cautiously. While some indicators seem strong, significant vulnerabilities persist. Audiences are encouraged to consider defensive investments and keep a close eye on economic trends.
What do you think? Are you shifting your investments?
Drop your thoughts and predictions in the comments. Let's navigate these waters together.
Welcome to David Lin's YouTube channel. Today we're diving deep into the turbulent waters of market fluctuations with none other than Jack Schwager, the best-selling author of the renowned Market Wizard series. Buckle up.
That's right. Jack has spent over 3 decades interviewing some of the brightest trading minds. His incredible insights on market dynamics are just what we need to navigate today's uncertainty.
So Jack, what's the main takeaway from your insights today?
The core thesis revolves around understanding market volatility. The failed signals, such as bear and bull traps, suggest that traders need to be cautious, yet optimistic, as they can indicate significant turning points.
Let's nail down those key points, starting with current market dynamics. What are we seeing?
Recent market volatility suggests that we're at a critical turning point. Interestingly, failed breakout signals, often seen as traps, can show underlying strength.
What about technical indicators like RSI? Are they still relevant?
Here's the scoop. Using RSI, contrary to accepted norms, buying when it's high and selling when it's low, could actually yield better outcomes. Trader psychology often misinterprets these signals.
Now, how should traders position themselves during these unpredictable times?
That's crucial. Successful traders tend to stay long during volatility, picking their spots carefully to capitalize on the best opportunities.
Geopolitical tensions are everywhere. How are they impacting trading?
Yes, rising tensions and uncertainties about Fed decisions can significantly sway market movements. Traders need to be vigilant.
What do the future market conditions look like?
Expect increased volatility ahead. Traders must adapt their strategies to remain successful in this unpredictable climate.
And what about the broader economic landscape?
Absolutely. Geopolitical events will drive market trends. It's crucial to shift focus toward effective risk management strategies.
To wrap it up, what are the key points we should take away from this?
Understanding these market signals, especially the concept of traps, is essential for traders navigating current volatility. Stay informed and stay strategic.
So Jack, what final advice do you have for our viewers?
Adaptation is key. Focus on risk management and understand that your trading strategies may need to shift with the market.
Before we sign off, how about you viewers? What strategies are you employing during these volatile times?
Drop your thoughts in the comments. We're keen to hear how you're navigating these waters.
Welcome back to Trade Brigade's pre-market prep. Today is Friday, August 16th, and the markets have been on a non-stop rocket to the upside this week. Can we keep the momentum going?
Definitely. Today we look at whether the market can cool off a bit or if it will keep squeezing shorts. With so much volatility, today promises to be interesting.
What's the core thesis today?
The primary takeaway is that the market opens in a neutral position, indicating it may balance out after the upward surge. It's about finding opportunities without chasing highs.
What key economic indicators should we watch today?
Look out for consumer sentiment readings and inflation expectations at 10 a.m. These will impact market sentiment significantly.
How are the futures looking as we open?
Overall, the Dow futures are slightly down, oil prices are seeing a big drop, and sentiment is cautious after an aggressive week.
What's on the calendar for next week?
Next week, the Jackson Hole Symposium is crucial. Keep an eye on Jerome Powell's keynote, as it could spark significant market reactions.
What's the general market sentiment right now?
There's a bit of nervousness. Traders are looking for signs of a pullback after such significant gains throughout the week.
Any predictions on market behavior as we near market open?
Expect a potential pullback, but if we establish higher lows, the market could rally again.
What about the shorts in this market?
The squeeze on shorts may continue, provided there's no immediate bearish sign present.
To wrap things up, what's the final takeaway?
Patience is key today. Keep an eye on market indicators and don't over-leverage your trades. There's always next week.
What should traders focus on as the day unfolds?
Definitely watch the Consumer Sentiment Report at 10 a.m. It's critical for today's trading decisions.
Before signing off, what do you think will happen today?
Let us know your thoughts in the comments. Are the markets poised for a pullback or another leg up?
Welcome to Eurodollar University. Today's topic dives into the recent steel price crash and its far-reaching impact on the global economy. Buckle up, because we're navigating some rough economic waters.
Indeed. This discussion focuses on stark warnings from the world's largest steelmaker and the concerning signs from China's economy. Get ready for some crucial insights.
What's the central thesis from the video? What's behind the crashing steel prices?
The core thesis revolves around the idea that plummeting steel prices are warning signs of deeper economic troubles, especially when noted by leading steel executives. This suggests an impending recession that could affect economies worldwide.
Let's kick things off with the steel price situation. What are the specifics?
Steel futures in China have plummeted by nearly 16% just this past month. Additionally, iron ore prices have hit the lowest since November 2022, indicating severe overproduction and collapsing demand.
China's economy seems to be in a tailspin, right? What are the particulars?
Exactly. There's a significant downturn in key indicators. Retail sales only grew by 2.7% year-over-year in July. Industrial production growth has slowed, and housing prices are continuing their downward spiral. It's grim.
And this excess production in China isn't just a local issue, right? What's at stake globally?
Correct. As China dumps excess steel onto global markets, expect deflationary pressures to ripple across economies like Australia and Brazil, leading to potential crises in those markets.
Now, what are the predictions here? Could we really be staring down the barrel of a recession?
Absolutely. The speaker suggests that if steel prices continue to collapse, we could be facing a global recession, spurred by China's economic challenges and reduced demand worldwide.
Wrapping things up, what are the major takeaways?
The steel industry's turmoil highlights profound economic challenges that could ripple through global markets. It's time for decision makers to act. What do you think will be the next big move in response to this crisis? Comment below with your thoughts.
And which markets should we keep an eye on as this unfolds?
Watch closely as this saga develops, especially in commodity-heavy economies like Australia and Brazil. They'll feel the impact sooner rather than later. What insights do you have? Join the discussion.
Welcome to the Technical Traders on YouTube. Today, we're diving into the intriguing interplay between the stock market, bonds, and gold. Who's feeling adventurous? Buckle up, because we've got some market updates coming your way.
Right on. Today's focus will shine a light on current market trends, pressures, and what's unfolding with our precious metals and bond prices. Let's get straight to the facts.
So what's the key takeaway from this discussion? What's driving the shift?
The core thesis reveals that as the stock market shows signs of strain, investors are increasingly turning to bonds and gold, anticipating potential opportunities amid volatility and risk.
All right, let's chart the course through those key points. First up, stock trends. What's happening out there?
The market is showing vulnerability, depicted by a drop in the Nasdaq by about 0.6%. Investors are starting to feel the jitters.
And what's the situation with bonds?
Bonds are climbing. We've seen bonds consolidating in a positive formation, signaling potential upward movements as stocks falter.
Heading over to gold. What's the activity there?
Gold is on the verge of breaking new all-time highs. It continues to attract investments as a safe haven during turbulent times.
Let's not overlook sector dynamics. What's the scoop there?
We're observing a shift with more than half of the sectors turning bullish, but many are in a complacency phase, an interesting mix.
Time for a forecast. What predictions are on the horizon?
Expect to see increased investing in bonds, while gold is poised to shine as we approach the year's end. Everyone's turning their compasses toward the safe shores.
To wrap it up, what should investors keep in mind?
Stay alert. The market is shifting, and bonds along with gold seem to present promising opportunities as the stock market faces challenges. Viewers, have you followed suit? Share your thoughts in the comments.
And lastly, what's the call to action?
Keep vigilant over the economic indicators. These will guide your investment strategy through this changing tide.
Ahoy, market navigators. Welcome to Figuring Out Money, where we're charting the waves of the stock market. Today's topic is the S&P 500 ready to pump the brakes?
Definitely a pressing question. The latest movements suggest it's time to get straight to the facts. Buckle up, we're diving deep.
All right, let's talk about the core thesis of today's episode. What's the main idea?
The main takeaway is that the S&P 500 has hit a new high, but indicators like the VIX suggest we're entering potentially frothy territory, signaling a need for consolidation.
What's the scoop on the recent market movement?
The S&P 500 surged by 1.71%, which is a notable move. It's like hitting the turbo button on your boat.
Can you explain those bridge bands you mentioned?
Sure. These bands provide a fractal overview, and currently the SPX is at the higher end, while the VIX is down low, signaling potential consolidation ahead.
What's the historical context that supports this?
In prior instances, similar signals led to consolidation after strong moves, showing that what goes up can meet calm waters.
What does the future hold for the market?
Expect a period of consolidation soon, with potential for higher volatility ahead. It's all about navigating those currents.
To wrap up, what should our viewers take away from this?
While the S&P 500 shows strength, the signals indicate it's time to let off the gas a little. Viewers, what strategies are you considering? Drop your thoughts in the comments.
Welcome to Oxbow Advisors on YouTube. Today we're navigating through the economic currents as we welcome back the insightful Ted Oakley, who brings over 40 years of market experience.
Exciting to have him back. With Ted's impressive background and keen expertise, he provides a macro view on our economy and potential market trends.
So what's at the core of Ted Oakley's observations? What should we be on the lookout for?
Ted's main thesis is that while many economic signs indicate stress, the stock market continues to rise, leading to potentially dangerous overvaluations.
Let's tackle those key points. What's going on in the economic landscape?
Ted illustrates deepening issues with rising delinquencies in credit cards alongside serious troubles in commercial real estate.
And what about the Federal Reserve's actions?
Ted critiques the Fed, suggesting it's overly focused on stock market performance, often to the detriment of the economy.
What does Ted say regarding the middle class's plight?
He points out that many families need dual incomes and face skyrocketing home prices, which has priced them out of the American dream.
So any predictions Ted shared?
Definitely. He predicts a rise in bankruptcies, highlighting how business closures can place significant stress on consumers.
What does Ted forecast regarding possible Fed rate cuts?
Ted warns that lowering rates may signal worsening conditions and lead to more loan defaults, creating a vicious cycle.
As we wrap up, what are Ted's key takeaways?
To navigate these choppy waters, Ted emphasizes the need for balanced portfolios and awareness of economic pressures that can impact investments.
Any final thoughts Ted shared about investor preparedness?
Absolutely. He warns that many over 60 are overly leveraged in equities, urging a more balanced investment approach. What are your thoughts on this? Jump into the comments.
Welcome to the Bob Elliott channel. Today, we're uncovering the fascinating shifts in U.S. debt regulation following the global financial crisis.
That's right. Bob Elliott dives into the substantial changes that have come since the GFC, emphasizing how these shifts have shaped the economy we see today.
What's the core thesis behind today's discussion?
The key takeaway is that U.S. regulations restructured after the GFC have made our debt landscape safer, minimizing the risk of cascading failures.
Let's break down some key points. How have things changed since the crisis?
Post-GFC, banks are required to hold more capital, and most mortgages are now fixed rate, a massive shift from 2006 when many were linked to floating rates.
And what about the government debt? Any distinctions there?
Absolutely. Unlike private sector debt, the central bank can essentially write off debt when needed, similar to how Japan managed their high levels.
Interesting. So what's the deal with interest rates?
Bob argues that, in fact, interest rates might need to increase considering the current economic strength rather than decrease, as many expect.
Let's pull out the crystal ball. What are the predictions moving forward?
First off, the yields need to rise significantly before the central bank would consider interventions to ease the debt burden.
And what about long-term forecasts?
It's clear there will need to be pain in the bond market before any significant adjustments happen. We're just beginning this journey.
As we wrap things up, what's the bottom line?
It's all about understanding how these structural changes impact investments and economic stability going forward.
What do you think about these changes in debt policy?
Drop your thoughts in the comments. Let's get the conversation going.
As we wrap up, we saw Stephanie emphasize the importance of holding cash and gold amid increasing financial risks.
Jack's perspective on navigating volatility urged traders to be cautiously optimistic as market conditions shift.
Looking ahead, Ted's concerns over the stock market's overvaluation highlight the need for investors to remain vigilant.
Bob's insights reinforced how regulatory changes post-GFC have reshaped the debt landscape, creating a safer yet complex environment for borrowers.
Thanks for watching Financial Insights in Minutes for August 16th, 2024. If you'd like more time-saving content, please remember to like and subscribe. If you have ideas for more channels you'd like to see summarized, drop a comment below. See you next time.